Portions of KDKR's daily programming do not necessarily reflect the views of the management or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, should employees be able to sue employers because of 401k plans? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, please go to the website at www.prudentmoney.com and send it in to the Ask Bob page. It's a great way to get information. I'm always that's always available to you. So take advantage of that if you've got a question and or a comment. We definitely want to make sure that you get taken care of. That's all at the website, www.prudentmoney.com. Let's talk a little bit about fiduciary responsibility. Before you turn the dial, hang with me on this. I know it doesn't sound like an exciting topic, but fiduciary responsibility, or the word fiduciary, is a big buzzword right now. And simply put, it means, or fiduciary responsibility means that the individual that's taking care of investments for you or is making recommendations to you, whatever it might be, or providing something for you, is doing so in your best interest and putting your interests ahead of their own interests. Pretty straightforward. You'd like to think that everybody is following the fiduciary responsibility that is helping you with your financial life. But that's not always the case. So what has ended up happening, and this is drawn on for, I don't know, maybe 4 or 5 years, the politicians in Washington were working to figure out what is the definition of fiduciary responsibility, what should the new fiduciary laws look like, and they went through many legal battles and finally came up with something that I think is like 1,000 pages, when really at the end of the day, there's 2 or 3 things that you can do to assure that your best interests are being looked out for. So the fiduciary responsibility that they were most focused on was the fiduciary responsibility of clients and financial advisors. And I believe I heard that right. It's like 1,000-page document. What is happening, though? There's also fiduciary responsibility on some level between a 401k provider, an employer, and the employee. And the whole problem that's looked under the microscope is, once again, is this 401k plan in the best interest of the participants? So let me give you a couple of examples where this would not be the case. It would not be the case if someone was getting a kickback, if higher charges were being charged and they were going to 401k providers and the 401k providers weren't doing anything. You can kind of see where they would be putting their interests ahead of yourself. And a lot of times it does come down to fees and commissions. But in this case, the cases I want to talk to you about today, this is where an employee is suing, mostly in class action type suits, are suing their employee or 401k provider. It just depends on the situation. Employer or a 401k provider, based on performance. And so this trend started, I don't know, maybe 2 or 3 years ago, and now starting to see a lot of these suits surface. And personally, I believe it's a bad precedent that's being set, which I'll go through here in just a minute. So let me back up and talk about, well, what did employers do to make sure that they were not taking that particular liability? basically what they did is they moved to index funds. So an index fund is a mutual fund that follows a certain stock market index. So if you had your money in the S&P 500 index fund, which mimics the S&P 500, if you lost money, well, there wouldn't be any liability there for the fiduciary responsibility because you knew what you were getting yourself into. Now, let's say questionable fiduciary responsibility is you put your money in that index fund, and that index fund loses 25%, and the index didn't lose 25%. Well, that would be a problem. But what they did, they went to index funds where there's no real margin for error. You see, you get what you see what you get what you see. And these target date funds. Now, you know, if you listen to me, that I'm not a big fan of how these target date funds how they're put together and how they work. And I've always said, and it looks like it's playing out, is that in my opinion, what they are doing, the step they're taking by putting target date funds in 401ks across the country to eliminate the liability of fiduciary responsibility, they are actually increasing their liability. And I think that they're starting to see that right now. A target date fund is a fund that is specifically tied to your retirement date. So let's say that you wanted to retire in 2030. Then you would put your money in the target date 2030 fund. And by doing so, your money would follow this glide path, that's what they call it, to your retirement, to where each year they would take a little bit of less risk, and so forth until they got you to retirement. My argument has been the entire time that these target date funds have been taking way more risk than the marketing material suggests. And then within the target date fund community, there are certain target date funds where money managers have tried to take more risk to try to boost their performance. Well, that's not what a target date fund is for. Target date fund is strictly for the management of risk. I'll never forget Fidelity had a commercial was running a commercial on target date funds. I think they call them something else, but it's same principle. And this guy is interviewing this couple, and the commercial makes this couple look so incredibly clueless, as the guy, I guess the guy was with Fidelity, was asking them, talk about your retirement. And the gentleman said something like, well, they just change risk levels and keep me safe and get me to retirement. I don't really know much more than that. And I thought, if you had a 401k plan and that's where you were working really hard to fund that 401k plan with hard-earned money that you've go to work for every day of the week or 5 days a day of the week, and you don't really know that any more than that of your 401k plan. I think it's just something important to know. The problem is that at some point you set a certain standard for what the return is supposed to be for a target date fund that's 5 years out from retirement. And you get that standard by looking what the average return is. If you're taking more risk, you risk the possibility of not doing what you're supposed to be doing with this target date fund. So for instance, if their argument is, in these court filings, which we'll read a couple of them here in a second, their argument is, hey, you have me in the 2025 target date. Year to date, let's say for 2022, everything has lost money, almost everything. you look at it and it says, well, the 2025 average is down 8%, and your target date 2025 fund is down 15%. Well, that shouldn't be. That shouldn't be down that much. And so that's kind of their argument, is that you were not looking out for your fiduciary responsibility. Here's a couple of cases. Between July 29 and August 2nd, lawyers representing current and past participants in 6 separate retirement plans filed suit against their employers and plan fiduciaries, charging that the BlackRock target date funds in the plans performed worse than other popular target date funds. I cannot even begin to tell you what a slippery slope this is, these lawsuits, basing it on performance. But I'll get back to that here in a second. Those lawsuits come 4 months after mutual fund giant Vanguard was served with a class action suit charging that Vanguard mismanaged some of its target date funds to the point where the investors were slammed with excessive tax bills. Now, if they can prove that, that's a real problem. I don't know that that's fiduciary responsibility more than negligence, but that is a real issue. But the thing is, of course, that's not affecting IRAs or 401k. That's mutual funds, people with taxable mutual fund accounts, and paying more taxes than they should. So we'll get back to this story after the break. We are up against one, so stick around. This is Bob Brooks. You're listening to the Prudent Money Radio Show. We'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, pastorchuck.org. At pastorchuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at pastorchuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, pastorchuck.org.
Do you find yourself overwhelmed after watching the news? Sing more songs. A lot of our anxiety comes from the fact that we look at our God as being too small. Not that we're not tempted to do that, but we need to sing more psalms. Please join us 5 a.m., 1 p.m. Saturday, and 7 a.m. Sunday to hear Jason Wallace give expository teaching of the Bible.
Hi, this is Kirby Anderson with the Point of View Radio Talk Show. I want to invite you to listen to our program on KDKR from 1 o'clock to 3 o'clock p.m. Monday through Friday. We look at various issues from a biblical perspective. Our topics range from politics and economics to the Bible, theology, and apologetics. We also bring authors and informed experts to the program. We talk about anything that affects your faith, your family, or your freedom. Hope you'll join us every day on Point of View right here on Bible School Radio 91.3.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website, send that question in, and I will get you taken care of. I really do answer all my emails. I think sometimes people believe, does he really answer his emails? Do those go in a big black hole? If you've ever not gotten a response from me, please let us know, because it's very important. Spam filters are a real thing, and sometimes I get caught up in them. So make sure that you reach out and let us know, and we'll get you taken care of. You can always send an email at info@prudentmoney.com if that works a little bit better. We're talking about fiduciary responsibility and the problem that I see with employees suing their employer over performance. I talked about a couple of the suits that are recent. It goes on to say, in addition to the legal actions, this was Vanguard. No, I'm sorry, this was the legal actions in general. Two recently issued reports cast doubt on investing in target date funds in retirement, charging that such funds often carry too much risk for retired investors. Thank you for someone finally printing a study or something that says that's the case, because it is the case. The reports from research firm Morningstar and Boston College's Carroll School of Management and the TIAA Institute found that the funds don't provide the flexibility and guidance older investors often need, and that the equity exposure and target date fund exposes retirees to too much risk. Once again, I've been saying this for years, and it's really bothersome because people will buy into well, this is a great strategy, it should work, and it should limit my risk, when it's probably increasing your risk more than you want it to do so. I'll give you a good example. Remember back in the financial crisis of, we'll say, the year of 2008, the market, I think, lost 37% that year, and the target date fund, that was in 2008, the target date fund of 2007, I believe, or 2005, which means they were already, if you're in that fund, you're already in retirement, lost 9 to 10% that year, which only tells me that they were taking way too much risk. Another fiduciary lawsuit, John Rex, CFO of United Health Group, has been named in a class action lawsuit alleging that healthcare giant put its own business interests above retirement plan participants. Now that's classic fiduciary liability. The suit alleges the company's 401k retirement plan invested in low-performing target date funds. John Rex gave preferential priority to United Health's relationship with Wells Fargo, which I don't see how they can prove that, which managed the funds and kept those interests even when they underperformed, the lawsuit alleges. Now, should employees be able to sue based on performance? These, as I even read these, I think it's absolutely ridiculous. Let's start out. Let's look at a few things. First and foremost, investors have responsibility, and they should not get a free pass. As you as an investor in your 401k plan, you shouldn't get a free pass by you putting money into your 401k plan, it losing money, and you go, well, you picked out the wrong fund to be in your 401k plan, and they're underperforming, and therefore I'm going to sue you because of my losses. Should not ever be the case. You should, as an investor, be a co-manager or a co-steward of those funds. I just think it's an awfully slippery slope. Number one, you're not entitled to the best or average or best performance. Employers or 401k fiduciaries can't forecast returns. And then one of these suits was based on an 11-year time period. Who bases anything on 11 years? How about 1, 3, 5, and 10? So are you going to tell me that you're going to file suit for a fund that was hitting its averages in 1 year and 3-year returns and not in 5-year returns? And now target date funds are an easy target, lack of a better word, as far as these lawsuits, because they're supposed to do something that I don't think that they're necessarily set up to do. Now, if I was a fiduciary for a 401k plan, I would stay away from the ultra risky funds. Said another way, I would protect my employees from through 30 years of investing and managing money, I've come across there's always these funds. And this was especially in the during the technology boom and the bust that came after in 2000, where you would have this tech fund and it would be up, 128% or 90% in a year's period. Nobody was filing lawsuits then. Then the fund completely lost almost everything by the investments that got them there, took them back down. Now, I guess who's going to get sued because of that? So I think that you by putting ultra risky funds in your 401k plan creates a lot of liability. There's also a fiduciary responsibility, I believe, and not a lot of 401k plans do not have this, and I think they're taking liability, is not to have any safe type mutual funds or funds inside the 401k plan for people to go to if they don't want to take risk, like a stable value fund or something like that. And as we've seen this year, bond funds certainly are not a safe alternative, as they've all lost money. Now, fees, if proven to be excessive beyond the average rate, I think there's a case for it there. Excessive broker commissions, definitely. Management fees being charged for doing nothing, definitely. Fraud, definitely. But the concerning aspect of this is that these judges that are trying these cases could be setting precedents that are not necessarily a good thing. And then you've got the liability of the Fidelities and the Vanguards of the world, who never, I guess they don't provide the role of fiduciary as being a fiduciary, but they do, in my opinion, the Fidelity commercial that they played, to where you had the clueless couple about their 401k plan and had not a worry in the world and hadn't looked at it in about 5 years, which are all things you really got to do. And then everything was okay. So does the mutual fund company like a Fidelity have any responsibility in this? Of course, that was a long time ago when they ran those commercials. But we shall see. It's an interesting thing. Like I said, I'm not a big fan of this type of situation because it's a slippery slope. And the other thing too, when you're talking about performance, what constitutes a violation of a fiduciary responsibility? Is it when the year return underperforms? Is it when the 3-year return underperforms? 5-year, 10-year? I mean, what is it that they're going to base this upon? And what is it that they're going to base the actual loss, percentage loss, as compared to their percentage loss as compared to the target date average? So there's a lot of different things. And so what you have in these situations, those judges who file in favor of the employee, that starts to define what the standards are. And I'm no attorney, nor am I trying to play one on TV. I'm just trying to show you the slippery slope and why this is not a good deal. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Hey, listen, have you gone and checked out our podcasting section? And that podcasting section on the website, and there is podcasting on whatever podcasting platform you like to hear your podcast. We're on it. So go check it out and like it, or do whatever the opportunities you have there. We would appreciate that. And also never forget that I'm always a question away if you got a question for me. Next couple of days, we're going to be talking about emergency fund money. What is the rule of thumb of finding a place to hold emergency money? Another question we're going to look at is the bear market almost over? And what's the future of the stock market look like? And then for the individual who is 2 or 3 years away from retirement, they've taken a big hit, and they're up against the question, should I sell investments and take less risk, or should I hang on to investments and risk this thing getting out of control and the losses getting even bigger? And it is a very difficult question to answer, but what I'm going to do is talk about the metrics, things that you want to consider, things that you want to look at, and guide you through that path. So that's just some of the things to look forward to on Prudent Money, and we'll keep you posted on what you need to know. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website at www.prudentmoney.com and send it in, because I am all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.